On to our next speaker this morning, and that is Gurpreet Gill, who's joining us from Goldman Sachs Asset Management. She is a macro strategist in the fixed income team and heads up the Fixed Income Insights group. She's a regular commentator in the media, on Bloomberg, CNBC, and she's going to talk to us today about the sort of shifting sands in the world today. So without further ado, over to you, Gurpreet.
So good morning, everyone. I hope you had an enjoyable and restful summer. I'm going to spend the next 30 minutes outlining 5 key themes that are reshaping economic cycles. And I hope you find this informative, even if it implies a not so restful era of investing ahead. Now, in a world of cycles, we are always heading towards a recession when we are not in one. And the probability of one occurring increases as time goes by and the cycle matures. So in the near term, we believe the US remains on a narrow path to a soft landing. Growth is decelerating to below trend. The labour market encouragingly shows signs of rebalancing. And goods inflation is easing, even as services prices such as rents remain firm. However, the outlook for the UK and Euro area is more challenging. And we do think that the energy crisis will likely tip both economies into recession. And the length and the depth and the severity of that recession is going to depend on offsetting fiscal support. But as I mentioned, I want to offer a longer-term perspective today on how global shocks and structural trends are reshaping economic cycles. And these economic, social, technological, and political changes and shifts that are underway are complex, they're nuanced, they're interrelated, and they're still evolving. But broadly speaking, we think they can be distilled into 5 key themes. Excuse me. So the first is deglobalization in goods and labor flows. The second is decarbonization of the global economy. The third is destabilization in geopolitics. The fourth is demographic aging. And the fifth is digitization of more industries and more activities. And taken together, we believe these 5 Ds or 5 developments are taking us from an era in which cycles were long, inflation was low, and growth volatility was also low, into an environment in which inflation is going to be a bigger risk than deflation, and growth is going to be much more volatile. Now, in no particular order, the first D that is sparking a change in economic cycles is deglobalization. Taking a step back, a shift away from a world in which goods, capital, people, technology, and data flowed freely was already underway pre-pandemic. We had populist movements that were favouring tariffs over free trade, and we saw restrictions on immigration. And the chart on the right-hand side here shows trade in global goods as a proportion of GDP, which has been trending down since the global financial crisis. And 2 key factors point to a continuation of this trend. The first is an increased focus on supply chain resilience as a result of disruptions experienced due to the pandemic, but also Russia's war in Ukraine. So companies are now increasingly focused on just-in-case rather than just-in-time inventory management. So far, the data shows that the way that companies are bolstering resilience is through diversification of supply chains and through inventory overstocking. Now, that's not necessarily consistent with the deglobalization narrative, but we think it's probably too soon to see that shift. And we do expect more local production, at least in certain goods. And that takes me to the second point, which is considerations of national security. So governments are now undertaking strategic reviews in industries that are deemed to be important to national security. Think healthcare, energy, and technology. And we already have evidence of the US Chips and Science Act and the Next Generation EU Recovery Fund looking to incentivize domestic semiconductor manufacturing in order to hedge against future disruptions that may be caused by the current concentration of both production and expertise in Taiwan and Korea. And there's two key economic implications of this. So the first is higher inflation. If we assume that more local production will entail more expensive local labor and input costs, and is not offset by increased adoption of digitization, which I'll talk about a bit later. And the second economic implication is higher growth volatility, as the prominence of these more cyclical sectors is increased because they had previously been offshored. Moving on to other elements of globalization, the chart on the left-hand side here shows globalization as it relates to trends and flows in capital and labor. And again, like goods, cross-border flows in direct investment has declined relative to GDP. And the same trend is reflected in labor. Net immigration in major developed markets has been trending down over the past decade. However, if we turn to this slide, I would note that globalization is still live and kicking in certain areas, in particular in trade of services. The chart on the right-hand side is showing that trade in services such as tourism had been trending higher pre-pandemic, and there is no reason to believe that the desire to travel and to connect with the world will not resume once we are beyond this pandemic period. Another area where globalization is still intact and, if anything, growing is in trade of technology, data, and ideas. And the chart on the left-hand side here shows a significant rise in the exports of computers and communications since the early 90s. Around 80% of this is driven by video, social media, and gaming services. And in fact, cross-border internet bandwidth is 115 times higher today than it was in 2008. So overall, deglobalization in goods, capital, and labor does point to higher inflation outturns in the coming years, but there is some disinflationary offset from continued trade in services, and particular digital services, especially as economic activity is increasingly oriented towards the services sector. Now, the second major theme reshaping the global economy is decarbonization. Now, addressing climate change is often conceptualized as a single issue, but it is in fact many interrelated issues impacting all domains of life, so agriculture and food production, the transport sector, finance, energy, etc. And then also beyond the issue of greenhouse gas emissions, there's also interconnected and interrelated issues of a loss of biodiversity, considerations around a just energy transition, so climate justice, and so on. But if we focus on the economic elements of decarbonization, then decarbonizing the global economy requires three things: incentives, investment, and innovation. Now, on the incentives front, in theory, the most effective way to correct for the negative externalities of climate change and carbon emitting activities is to align private costs with social costs. So in other words, in order to nudge people away from fossil fuels, we need a carbon tax. Here in the UK, we can think of one clear example of that is the 10p or 15p charge attached to plastic carrier bags in supermarkets, which very quickly nudged people to use reusable bags. But unfortunately, in practice, a carbon tax faces political opposition given it's deemed to be regressive in nature. And that is why just 23% of global emissions are covered by some form of carbon pricing mechanism. The more encouraging statistic, however, is that 85% of emissions are now covered by climate action targets. And achieving those net zero targets and ambitions is going to require a colossal amount of investment. $50 trillion by 2050, to put a figure on it, or $2.8 trillion of incremental investment each year relative to recent averages, as shown on the chart on the right-hand side here. And this presents inflation implications yet again at both a micro and a macro level. So at a micro level, increased demand for the metals and minerals that are required for clean technologies is already pushing up prices. To give you one example, electric vehicles use 6 times more minerals than their conventional counterparts. Another example is that an offshore wind plant requires 7 times more copper compared with a gas-fired plant. And demand for these metals and minerals is rising, but supply, at least in the short to medium term, is constrained, given it takes many years to develop production capacity. And so that is putting pressure on these prices in the near term. And then at a macro level, the amount of investment required has potential to lift aggregate demand and therefore broader inflation. That being said, as an economist, we hedge everything we say, and the inflation consequences could be lessened if consumers and producers are able to shift towards cost-effective green alternatives quicker. But on the other hand, the inflation consequences could be much larger if the transition is delayed. Over time, however, we are hopeful that innovation, scale effects, and production efficiency will alleviate this green inflation or greenflation. And then in addition, beyond protecting the health of the planet, another positive implication of this energy transition is the creation of green-collar jobs. So a solar engineer, wind turbine technicians, battery experts, etc. And as shown on the left-hand side here, as of 2018, the renewable energy sector employed 18 million people. This could rise to 30 million by 2030 and 42 million by 2050. So overall, we do think that decarbonisation will be inflationary, at least in the near to medium term, but over time, that inflation, that green inflation, should subside. Now, sticking to labour markets, the third D impacting major advanced economies, at least, is demographic ageing. The chart on the right-hand side here shows how age pyramids are inverting in the coming years due to consistently low birth rates and higher life expectancy. And this does not actually just apply to developed markets. I saw a stat yesterday that life expectancy in China has now surpassed the US, which is remarkable. And as this aging occurs and as baby boom generations retire, the pool of available workers in the workforce is going to shrink. And recall that pool of available workers in major economies is already shrinking due to the deglobalization in labor that we're seeing. And all of this will create an upward impetus on wages, which are a key determinant of medium-term inflation outcomes. That said, like everything, there are some offsetting factors. So first of all, we could see health advances and lifestyle choices lead to people remaining in the workforce for longer. Secondly, older voters tend to favour policies that tame inflation, given inflation erodes the real value of their retirement savings. And then third, notwithstanding the uptick that we have seen in union action this year, the broader downtrend in union membership and collective bargaining coverage is unlikely to fully reverse, and that has been a key factor behind muted wage growth. And then finally, the pandemic has shown the power of flexible working and the power of digital offices. And so going forward, this could help to broaden labour force participation, particularly among parents and particularly among people with disabilities. So overall, demographic ageing does have potential to be inflationary through its impacts on the workforce, but technology and hybrid working, flexible working, may offset some of that. Now, the fourth D impacting cycles is destabilization in geopolitics, as evidenced in recent years by both the US-China trade war and this year by Russia's war in Ukraine. Taking a step back, economic and political alliances rarely changed in the early era of globalization, but that looks like it's now shifting. And we believe that a world that divides into blocks, with the UK, US, Euro area, Japan, and other major developed markets on one side, and Russia, India, China, and major commodity producers on the other side, is likely to be a world in which supply-side issues and supply shocks are more prevalent. And we're already feeling the effects on inflation from geopolitics today through food and energy prices. And what's interesting is the interrelation of this D with one of the earlier themes, which is decarbonization. As decarbonization accelerates, the geopolitics of commodity supply is going to shift from fossil fuels to the key metals and minerals that are needed for clean technologies. This chart is showing the top 3 producers for various commodities. And as you can see at the bottom, the US, Saudi Arabia, Russia are the 3 largest oil producers, and their market share combined for oil is 42%. But if you look at the top, the concentration for a lot of the key metals and minerals that is needed for clean energy technologies is far more concentrated. And it's concentrated in countries where political regimes are more unstable and where relations with the West are more frail. For example, almost 90% of lithium production is concentrated in Australia, China, and Chile. And for others, it's much more concentrated in China, not just the production, but also the processing and the mining. And so these high levels of concentrations, combined with complex supply chains, as well as physical climate risks, implies that unstable geopolitics is going to amplify or reinforce any existing supply issues. To put some of these issues into context, the International Energy Agency estimates that it takes 16 years on average to move mining projects from discovery to production. And moreover, mining assets are much more exposed to growing climate risks. For example, 50% of lithium and copper is concentrated in areas with high water stress levels. So overall, geopolitical instability means that the future supply of key commodities, which is already fraught with many issues, may be subject to greater disruptions, and that points to higher inflation yet again, but also higher volatility in growth. Now, the final D is digitization, and this is the only one with disinflationary implications. As I noted earlier, cross-border digital trade is experiencing relentless growth, and that's not expected to reverse given a rising share of modern-day life, from shopping to banking, to tracking steps, to socializing, to reading your notes for a conference, is powered by a smartphone. Or as our colleagues in our equity team say, technology is not a single sector, every sector is technology. And the pandemic helped to fast-track digitization of more industries, more activities in more countries. Like I mentioned, we now have digital offices in the form of Zoom, Slack, and Teams, and these can enhance productivity and also save commuting time. We've also seen an uptick in telemedicine and digital health monitoring. And we do expect continued growth ahead, not least given the trends that I outlined. Telemedicine, precision medicine, genomics, digitized health, these are going to be particularly important for aging populations. So overall, these trends such as digitization of business, the rise of e-commerce, and the automation of activity in factories, etc., will continue to serve as a disinflationary force in the cycles ahead. So how should investors respond to this changing economic order? Well, for fixed income investors, we see three key implications. The first is a recognition of the new alphabet. So in other words, as I mentioned, we're moving into an environment of higher inflation, higher growth volatility, and ultimately higher risk premiums. And all of this means that investment opportunities are going to be much more alpha-driven rather than market beta-driven. The second key implication is a need to keep calm and carry on. So we have scaled down exposure to corporate credit recently in light of growing growth risks, particularly in Europe, and we have rotated towards investment grade higher quality as opposed to high yield for similar reasons. But we remain overweight as unless you expect a large-scale wave of downgrades and defaults, which we don't, given the strong starting point for balance sheet positions entering this macro mix of decelerating growth, high inflation, and withdrawal of policy support, then we think there is a high bar to not be invested in credit, given carry and roll is the dominant driver of excess return in portfolios over time. And then finally, we believe it is important to stay focused on investment opportunities that are aligned to delivering sustainable growth. We believe this is critically important for sustainable investment returns. And in short, this involves remaining aligned with structural themes such as the accelerated digital revolution of more industries in more countries, as well as decarbonization of the global economy. One way that fixed income investors can align to that decarbonization theme is through an allocation to green bonds. Green bonds are used to support the investment in environmentally friendly projects, assets, or activities. And the proceeds of those bonds not only helps to accelerate and move along the transition, but it can also help to improve climate resilience to physical climate risks. Another opportunity that can be linked to the energy transition is our exposure to companies that are responsible for the infrastructure needed for electric vehicles. To give you one statistic, the United States has 6,000 fast-charging electric vehicle charging points. This compares with 150,000 fuel stations. And so that implies huge growth runway for companies in that space. And as I mentioned, the rising share of modern day life is powered by data and technology. People have said that data is the new oil. This year has demonstrated that is not yet the case, but data is increasingly important. And so that presents opportunities in companies and data providers, so the bonds issued by key communications companies. So overall, we believe that this complex investment environment really underscores the importance of diversification, dynamic exposures, and astute bottom-up bond selection.